12. It's 10 o'clock. We are at the New York Comptroller's Office, 1 Center Street, room 1117D, New York, New York. Can we have a roll call of trustees, please?
Roll call of trustees. Ms. Ranji Nagaswamy. Here. Mr. Larry Schloss.
Here.
Ms. Janice Emery. Here. Mr. Stephen Cassidy.
Mr. Slevin is Mr. Cassidy's proxy.
Mr. James Levin.
Here.
Mr. Robert Straub.
Here.
Mr. John Kelly.
Mr. Straub has Mr. Kelly's proxy.
Mr. James McGowan.
Here.
Mr. John Dunn.
Here.
Mr. James Lamonda.
Present.
Mr. Sean O'Connor.
Here.
Commissioner White.
Here.
24 votes and a quorum. We can start the meeting.
Okay, we're going to start the public agenda. Larry?
Okay, thanks. Usually we start with the macroeconomic overview and then we go through the results. As you know, once a quarter we bring in an outside economic advisor. Today we have Bill Lee from Citigroup. Bill's outside. So we'll bring Bill in and we'll hear his views on what's going on.
Good morning. My name is Tim Sheridan. Good morning, sir. We appreciate the opportunity to speak to you today. We've brought in one of our economists, Bill Lee. Bill's a managing director in the office of the chief economist here at Citi. Prior to joining Citi, Bill has been with the IMF for 18 years and before that with the New York Fed. So Bill's going to speak a little bit today around the global economy, provide an overview, and talk about some of the opportunities that exist.
Great. Thank you very much, and thank you for having me here. It's really a great honor for me to talk to you because as a New Yorker, I used to go hang out at the fire departments quite a lot, and I used to be part of my playground. So I feel very good about being able to talk to you guys about what to do with your money. You know, because I'm a newbie at Citi, I'm going to have to sort of keep my IMF hat on for a while because my IMF hat is one that I think we share at Citi, is one that has a global perspective, a perspective that focuses in on the fundamentals of what's going on. So rather than review for you a blow-by-blow of how the economy's doing and what's holding back growth and why the euro area may or may not crack up, I really want to focus on the investment opportunities and how those are being reshaped by the changes in the global economy. So before getting there, let me just run you through how we at Citi and also we at the IMF view the global economies, because once you have a picture of what's going on in the rest of the world, you have a sense of putting in perspective where the problems are, what answers can actually solve those problems, and what's just a lot of smoke that covers up what the fundamental issues are. And having a global perspective also gives you a sense of options. Where are the options? And we at the IMF think that the global options are really very good right now. There are good opportunities because the world is not just the euro area, as important as it is. And what I'd like to do is to run you through how it is that we view some of these opportunities. One of the things to keep in mind is that we at the fund and also at Citi believe that the best opportunities for growth, productivity growth, and also profit growth are in those regions, countries, and with companies that are able to sustain rapid growth, and in those regions and countries that are able to absorb capital effectively. So keep in mind, those are the main criteria to look for when you look around at alternative places to put your money or investment choices. We at the IMF have spent a lot of time trying to address fundamentals all around the world to enhance their ability to sustain growth, to enhance their ability to absorb capital. So again, those are the two key ingredients. So let me start off by asking you to turn to page 3 of the handout. And this gives you a sense of how we see growth. Growth in the global economy comes on 2 tracks. The emerging markets are on the express track, and the advanced economies are kind of muddling along on a very slow local track of growth. On the next page, this translates to a situation where in the last 6 or 7 months, we at Citi, like everyone else, have become much more cautious about the global economy. That picture on page the top of page 4 shows we put in place some of the largest downward revisions to our outlook in the last 7 months since 2008. So the fact that we have these very strong headwinds is something that we're taking very seriously, and I'll run you through why it is that we have these headwinds. But just let me put some numbers in context. On the next page, on page 5, you see that we're projecting growth in the global economy to be something on the order of about 2.25%. And the euro area we are projecting is in recession now and will stay in recession well into next year. The engines of growth are still going to be the emerging markets, as you see in that red line there. They're going to grow at a fairly fast clip of about 5.25%. China will come out of its soft landing and settle in around 8.5% growth this year and next year. Let me stop for a moment and talk about China for a second. Everyone thinks of China as this low-cost center of production. They're able to produce things at such a low price that they're able to blow away all the manufacturing around the world. What that's caused in China is a huge income disparity, and that is a source of major concern for the authorities there. So as we speak, the Chinese are shifting their economy around. They're going to try to emphasize more consumption. They're going to try to raise wages, raise consumption, and allow more and more people in China to participate in the growth. What does that mean? It means that they're going to focus in on strategic industries that will cater to the domestic economy, healthcare, clean energy, and other technologies that they think they can have a comparative advantage in. So that's something that China will try to do in the next 5 years. That's in their 5-year plan, and we should believe their 5-year plan because China is still a command economy. Yeah.
If that's the case and they put more emphasis on the domestic and pushing up wages, how does that square with your forecast of relatively low inflation in the developed countries, which accept so many of their exports?
A lot of the low inflation has come about because of lower manufacturing prices. But right now, there's such a lack of demand in the advanced economies that there really isn't much pricing pressure anywhere. So as wages go up, they really have to take it out of the margins, which again means that other centers in Asia are probably going to take over the role as the low-cost manufacturing center. China will actually be more of an importer of goods and services to be able to supply its people with more product. So again, the China today and the China 5-10 years from now are going to be very different economies, and that's something that you should all keep in mind. That the stories of, boy, suppose, everybody in China bought a bottle of Coke, we'd be able to make a fortune. It may be true, but they'd be buying domestic Coke and not importing it. On the next page, because of the slowdown in the global economy that we see, the interest rate environment is going to be low for some time to come. The Fed has already told us not to expect rate increases until 2014 or beyond. ECB will likely cut interest rates again sometime between now and the middle of this year. So this low real interest rate environment, in fact, real interest rates will be negative for some time to come. So for the ability to get earnings by way of fixed income, it's a challenge right now, and will stay so, unless, of course, you start taking on some more risks, and we'll talk about that in a moment. On the next page, I hint at exactly why it is that we have these headwinds. The headwinds are coming about because the global economy is incredibly leveraged right now. And in fact, if you flip the page to page 8, I give you a sense of how highly leveraged the public sectors are. Generally, when we talk about leverage, we talk about debt to GDP ratios, the size of fiscal deficits relative to GDP. But it's hard to put those numbers in perspective because what are good benchmarks? Let me pick a benchmark that everyone has talked about for a long time, Maastricht. Maastricht was the treaty that the euro area used to determine economic convergence. The deal was the euro area will hang together and will function well if all economies converge. That means their deficits relative to GDP will be no more than 3%. Their debt relative to GDP will be no more than 60%. And those are the crosshairs that I put on the left-hand side there, on the left-hand panel. You see that there's not one country in the EU that satisfies Maastricht right now. If you look at the right-hand panel, there's no country in the world that satisfies Maastricht right now, except maybe China. So the notion of how highly leveraged we are really is, glaring when you look at that kind of perspective. The source of drag, as I said, comes from all this leverage, and that means that a lot of the economies are having to put in place fiscal consolidation, expenditure cuts, and everything else. And in the euro area, in particular, we're finding. Actually, before I go through the euro area, let me focus on page 10. The result of all this leverage creates all these headwinds for growth in the global economy. It took a while to get that leverage up there. It's going to take a while to get it down. The deleveraging process means you got to save more and pay off the debt. What that does to the economic recovery is what I illustrate on the right-hand panel there on page 10. A typical recovery is one where you have a shock to GDP, and the takeoff from the trough is actually very fast. And in the case of the United States, the takeoff would be something on the order of 3, 4, 5% GDP growth, not the 1 or 2% that we're experiencing now. And it gets you, the traditional recovery will get you back on that growth path that you were knocked off of. Here, in this deleveraging environment, we are having a prolonged period of higher saving to pay off the debt, lower output, and higher unemployment rate. And you see from the illustrative path I have there, it'll persist for some time to come as we lower our debt levels. The next panel on page 11, I try to give you a sense of how we, the United States, are doing relative to the rest of the world. And in the case of the EU and the UK, we're doing pretty well. In fact, compared to the Japanese recovery from their balance sheet recession, we're also doing pretty well. But I know you're thinking, God, things must be pretty damn pathetic if the economist is comparing us to Japan, because the Japanese recovery was also known as the lost decade, right? So things are not all that great looking forward in terms of growth as we sort of look at the global economy. Let me spend a few minutes and talk about the euro area, unless there's something I need to clarify on the headwinds. Yeah.
When you make a comparison to Japan, to what extent do you believe that the U.S. is in a better position because of demographics, because of access to natural resources, and all of those differences?
Exactly. All of the above accounts for why it is that our growth path is able to overtake the Japanese recovery. Exactly. Very much so.
On this trajectory that you have on the top right of on page 10, to close that gap, do we need more stimulus or do we need fiscal restraint?
$20,000 question.
How long will it be?
And what are you going to do about it?
At Citi, right, we're going to advise you how to walk around it. When I was at the IMF, the deal was we would tell the U.S., look, you've got to contain the rise in debt because the U.S. have an advantage of being a reserve currency. You can get away with issuing a lot of debt because people are willing to hold it because you are the reserve currency. But it won't last forever, and don't tread too far on this good graces of the world. So fiscal restraint is something that is needed to contain the uncertainties with regard to the future of the economy. The more immediate problem is that there really is not enough demand because people are not confident enough to spend. Businesses and consumers are too busy trying to restructure their balance sheets, pay down their debt. And so this is the argument that most people make, that we need some stimulus up front that can credibly be taken back later on. That's the key. That can credibly be taken back later on. And that's where you see all the impasse, all the political arguments and everything else, because no one is credible in being able to say we're going to take this back. Because once you start opening the wallets, it's very hard to close them, especially in an economy like ours, which is very entitlement-based. So once you have permanent expenditures put in place, what are you going to say? Oh, we're going to take away your Social Security. We're going to take away your mortgage deduction, because those are where the biggest gains would be. That would be political suicide. So again, by the way, we're not the only economy to face that problem. European economies face a similar problem. So I was on the German desk in Germany back in 1996 for the IMF. And coming from, as an American, I looked at the German economy at the time and said, my God, this is pathetic. High unemployment rates, high structural unemployment rates, low productivity, current account deficits. The unification was not going well with West and East Germany. Our advice was, you've got a basket case on your hands for the next 5-10 years. Well, suddenly now we view Germany as this economic miracle. What happened? They joined the euro area. They had a huge devaluation in the Deutschmark going into the euro of about 20-25%, and that helped boost their manufacturing. So a trick to get out of this kind of impasse is to devalue the exchange rate. And that's an option that we, of course, have, and that's what QE is all about, right? Instead, we no longer can lower interest rates, but by doing QE and a lot of easing of Fed policy, it allows the dollar to depreciate. So in terms of expenditure versus restraint, both. But there are other tricks to try to stimulate growth.
I read Krugman in the Times all the time, and my sense always is he takes a very different view, at least with respect to government spending, notwithstanding the issues of entitlements and all of that. I mean, do you take a very different view from Krugman? I just wonder.
Krugman is a genius.
That's what I thought.
He's always been a genius, and he knows it, right?
He does know it.
The trouble with Krugman is that he doesn't give you all the qualifications that he, as an economist, well-trained economist, would have in his head, and all of us who listen to him put in place. The qualifications are, this is an incredibly cheap time to borrow, so why not borrow at these low interest rates and finance a lot of deficit spending? The deficit spending has got to come back. You can't have permanent increases in the deficit because they'll just continue to raise the debt-to-GDP ratio. So when he says it's time to spend and spend big time now, it truly means one-time injections into aggregate demand. You know, dig some holes, have somebody else cover them up. That kind of stuff to just stimulate demand. Now, he's more sophisticated than that. He'll say we need confidence-building expenditures that'll allow firms and consumers to be confident that their standard of living will be better tomorrow than today, so they can start spending now instead of saving. That's the trick. And he's never all that specific about the types of expenditures, right? Because that's for the engineers, that's for the politicians. Well, that's the hard part. That's the hard part of the problem. Everyone knows, yeah, you should spend now, but how? So that's my response to the Krugman argument.
Okay.
He's right, but more details. Okay. And the devil is, in fact, in the details. Let me quickly go over the euro area, because I really do want to focus on where we think there are good opportunities and how you should look for them. The euro area you can think of as just a big fixed exchange rate area that's run into trouble. When you the euro area right now is confronted, the reason why it's such a big problem is it's confronted with three strong headwinds. First is a sovereign debt problem. They have way too much debt relative to GDP. So that means prolonged period of fiscal austerity, right? They've got to really rein in their spending. They've got to rein in their entitlements. The second problem facing the euro area is a banking crisis. The bank balance sheets in the euro area banks have deteriorated tremendously because they hold a lot of the sovereign debt. And what that caused them to do is to hold back on credit going into the euro area. And in fact, if you sort of turn to page 17, you see what I mean by the problem of the euro banks. Their share prices have tanked. They've resorted more and more to the ECB to get funding and to get liquidity, and as a result, they also have held back on giving loans to the private sector, which is what I show on the right-hand side there. The terms of lending have become much more sharper than they were before. It matters more for the euro area that there's a credit crunch than it would for the United States to experience a credit crunch at the same size, because the euro area is much more bank-centric. The companies and consumers in the euro area depend much more on banks for financing than we in the United States, because in the United States we have capital markets like bond markets and other alternatives for companies to issue and fund themselves. In the euro area, it's really all through the banking system, and once you clog the banking system, that's when you crunch activity. So that's the second headwind, is the banking crisis. The third headwind comes from the euro area countries running these huge and persistent current account deficits. What does that mean? Well, the first two headwinds is holding back growth in the euro area. This third headwind is tearing at the very fabric of the euro area. And why is that? Because, like I said, in any fixed exchange rate area, you're going to find some countries that run balance of payments deficits, others that run in surpluses. The way you hold the system together is that you got to transfer resources from the surplus areas into the deficit areas. And in the United States, for example, we have a currency union of the 12 Federal Reserve Bank districts. None of you care whether the dollar bill in your pocket is from the San Francisco Fed or the New York Fed. It all is locked at exchange rate of 1-to-1, and you're absolutely sure that it's going to stay that way. Why? Because we have a federal government transfer system, a tax and expenditure system that is able to tax from the rich areas and be able to finance the deficit spending in the more depressed areas until they're able to right themselves. And how do they right themselves? When unemployment gets really high in certain parts of the country, when jobs are low, people move, and they tend to move to other states where there are jobs. They don't have that mechanism in place in the euro area. So the euro area, in order to hang together, needs to put in place a more permanent fiscal transfer mechanism that's able to take resources from, call it Germany, give it to countries like Italy, Greece, Portugal, Spain. The Europeans are not willing to give up the sovereignty that implies, because if the Germans are going to give you money, they also want to be able to tell you, you've got to right your economy. You've got to do something to lower the cost of production. You've got to do something to become much more competitive. And that means changing your way of life. And that's the sovereignty that the Europeans are not willing to give up. So putting in place a fiscal transfer mechanism is tough. The other option is devalue, leave the euro area. There's no formal mechanism that allows them to leave the euro area. So as a result, we have this impasse. The Greek situation is a good microcosm of what's going on. Lucas Papademos was on my oral dissertation committee at Columbia when he was a newly minted assistant professor at Columbia. He's the straightest guy you'll ever meet. He is a guy who will pull together a good deal for everyone because he is a fair guy. That's why I put him on my committee, because I knew he was going to be fair. Well, he is, in fact, has put together a deal for the various factions in the Greek economy, but the unions and the civil servants and many of the others who are being asked to sacrifice are saying no. And that's where the political impasse is. And so I think one of the things to keep in mind is the solution to the euro area is to address the forces that are tearing at the fabric of it, and those are structural forces. Those are forces that require higher productivity, require low cost of production, require them to be much more competitive with their trading partners. Throwing money at them from the ECB is just like financing. It buys them time, but they got to use the time productively. So that's the thing to watch out for the euro area. Is whether you believe they're going to put in place policies that will address the structural problems or not. And so let me move on from there, unless there are some questions specifically about the euro area. Because I really believe there really is good news here. I mean, all this depressing stuff. Let me get to.
We're waiting for that.
All right.
I'm teasing. Obviously go as slow as you have to, but I would like to know.
So let me ask you to turn to page 21. Now, as the point of euro area is, there really is the rest of the world that we should talk about. And what we found in the last several years is that there's been a tremendous rebound in capital flows going into the emerging markets. And in a way, that's where we think the opportunities are going to be. And let me just say that as capital moves into these different regions, right, you got to ask what makes the capital move. What are they looking for? I know that no one's you guys are generally not economists in here, but I'm tempted to show you a set of regressions, right? Bunch of statistics. And the reason for that is because I want you to have in your mind what it is that we know about why capital moves and what we don't know. The next page, on page 22, is a bunch of regressions. I try to annotate and try to walk you through how to read the chart, but just focus in on the bottom line, the R squared. The R squared explains what we know about capital flows given the explanatory variables that I use that are basic economic variables. Interest rates, growth, country-specific opportunities, all that stuff is put in economic fundamental variables. The message here is we can only explain about half of global capital flows. And of the half that we can explain direct investment pretty well, about 2/3. We can explain bank flows pretty well, about a little less than a half. But portfolio flows, equity flows, fixed income flows, the R squared is almost zero. So don't let anyone fool you into saying, we know why it is that money is moving into Brazil. We know why it is. They may have some ideas as to why, but on a consistent and solid basis, they don't know why. In fact, that's why the Brazilian central bank and the authorities there are so reluctant to accept a lot of capital coming in, because they feel it could be very disruptive. If a lot of if a lot of capital flows into to a country, it appreciates the exchange rate. It kills the manufacturing. It causes a lot of disruption. Unless the economies can absorb the stuff. What allows economies to absorb the stuff? That's what's on the next page. If you look at that green box there, that's the result of a lot of research and a lot of sweat on the part of PhDs and failed dissertations. The green box tells you, in order for a country or a region to sustain growth into the long term, you got to have skilled workers. You've got to have infrastructure in place that will complement the private sector investment that's coming in. You've got to have countries that are open to trade. You've got to have a positive business climate, a market-oriented work culture. You've got to have supportive macro policies, policies where you also have adequate legal and regulatory frameworks that allow sufficient transparency so that you, the global investor, can see into the corporate sector and the financial sector and know what's going on. And a rule of law that allows contracts to be written, and an independent judiciary that allows contracts to be adjudicated if they're broken. But what's absolutely critical is that you need a financial system that's able to allocate resources to the best use. In other words, you got to watch out for crony capitalism and mechanisms that distort the allocation of capital in those countries. And I guess the other lesson from the modern research is on page 25. In addition to the stuff with that green box, the latest research says, a lot of countries absorb capital, a lot of countries get capital thrown into them, but they never grow. Why is that? Because they don't have sufficiently developed financial systems that allow them to be above key thresholds of development that allow them to efficiently and effectively absorb capital. And what I give you as an example of, as a threshold measure, is on the next page, called financial depth. Financial depth is nothing more than a gauge of how much credit there is relative to output. But this measure is really handy because it sorts out for you what it is that's successful. For countries that manage to increase financial debt, they develop their financial systems, and they do it above the threshold levels. Those are the countries that always seem to have sustained growth. So the countries I show there are South Africa, Singapore, China, Korea, Israel. The countries that increase financial debt, but somehow are always below that threshold, right, don't have sufficient development, are caught in this kind of what we economists call a low-level growth equilibrium trap. They have periods of growth, but it always peters out. They have periods of growth, but it always peters out. So countries there are like Turkey, Indonesia, Philippines, countries where they have a lot of potential, but it just doesn't come together. And so this is on the next page, I rank for you some of these emerging market economies using this measure of financial debt. So again, the message I have for you is, let's be strategic about how we look at things. Let's not worry about interest rates today, interest rates tomorrow. Look at for what it is in those economies that will sustain growth. You need, as I said before, all that infrastructure, skilled workforce, all of that stuff in place to be able to sustain growth, but you also need sufficient financial development to get you beyond key thresholds. And identifying these thresholds requires a lot of local information. You got to be able to have people on the ground who know those countries well enough to be able to assess, is this real, or is this just a bunch of stuff written up to satisfy outsiders like the IMF? And the IMF goes out of its way to send teams to each one of these countries several times a year to check up on what it is that's being put in place and to assess the policies. We at Citi have branches all over the world just for that purpose, to service the clients who are there, but to bring back intelligence about what's going on. So I think that's the main message I have for you, which is you need to be smart about how you identify growth opportunities. And I tried to lay out for you some of the things that we at the IMF certainly use and that we at Citi use as well. I'm sorry,
when you were on page 23, you mentioned the sort of indicia, human capital, effective infrastructure in place, et cetera, et cetera. But one of the things that struck me, what you mentioned also, you talked about a legal system that was amenable to these particular things that you mentioned: transparency, rule of law, independent judiciary.
Yeah.
And I was wondering how you thought that applied to China, for instance.
China's a command economy. And so what they're doing right now is putting in place exactly those things. And why is it that they've closed the capital account and have not opened it yet? Because they know that the minute they open the capital account, money's going to flood in.
And they're not ready for it, sort of?
I'm sorry?
Is it part of they're not ready for it?
They're not ready for it, exactly. And they know they're not ready. They've got some of the best trained regulators in place right now in their state councils. Some of them I've worked with, and they're the guys who got A at MIT. I mean, those are guys who are smart, but they don't have a lot of experience implementing policies. They can't recognize things that are done in the real world. And China is slowly opening itself up, allowing little experiments like dim sum bonds in Hong Kong, some other alliances in London, just so that their people can get experience working with the real world. And once they feel ready, they'll be opening up. To give you an example of why it is, that the Chinese financial system is not well developed yet, recently, in the last couple of years, they tried to boost their growth by allowing more credit to go into the system. Where did that credit go? Went into producing asset market bubbles and property bubbles in Beijing, Shanghai, and a lot of the coastal cities. That's my example of a failure, because a lot of that credit should have gone to small and medium enterprises and business people who are trying to create business that create trade for the country. But instead, it went into the wrong places. So those are the things that you got to watch out for. One last message in terms of what to watch out for. When you go into an economy, right, you got to ask, who else is there with you? Are there a diversity of players there? Do they use different strategies? Because the last thing you want to do is to go into an economy or a financial system where everyone's using the same trade. Everyone is on the same side of the market. Because that's been the cause of every financial crisis since LTCM and even way before that. Unbalanced markets, lack of diversity, that's really key. And identifying what's real diversity from sort of fake diversity is, again, something that requires a lot of local knowledge and local intelligence. Is there anything else? I know I think I've been told I've gone way over my time, so I apologize.
Any questions? Do you have any questions?
This is a packet, of course, there's much more detail in it than I went over. I hope it's self-contained, but please feel free to drop me an email or give me a buzz if you have any questions. I'm glad to talk to you.
Okay. If there are no other questions.
Thank you.
Thanks.
Thank you.
What?
And then you just said something about how they bought
Dim sum bonds. DINSUM. SUM is American. I know. So
Thank you.
that's all very quickly. I don't make life easy for you.
Yeah.
Just want to note that Leroy McGinnis is John Kelly's proxy for John Kelly.
Let's go back on the record a second. We're on the record. I just want a reporter. Would you repeat that, what you just said, Mr. Slevin?
Leroy McGinnis for the UFA, proxy for John Kelly.
Okay. Thank you.
No, all right.
Where are we here?
Good to go?
Yeah, we're ready for the public agenda.
All right. Let's go to we can skip a lot of the charts. You can look at them on your own. Let's just go to page 22.
Do you have an extra chart? Two. Give me two. Thanks. Thank you.
Short and sweet. 22? Good? All right. So, this is December reporting package. I'm going to go through it quickly because December was sort of a flat month. January was a great month. I'd rather talk next month about how everything worked great. But I think 22 encapsulates a little bit of what's gone on, at least in the U.S. stock market, which is measured by the volatility, which is VIX. So recall we had all sorts of calamities happening in the fall. The calamities were basically put aside because the ECB flooded the banks with 3-year loans. So everyone calmed down about the euro in Europe. and said, aha, they finally done the right thing. So a calm has now appeared in the markets. It started probably early to mid-December. In January, the markets are up 5% at least, and I'll show you that in a second. But again, if you look at what's encapsulated on this one picture, lots of volatility and then calm. So we're back in a nice calm phase. I'm sure there'll be more volatility because if you look at this chart, it comes and goes now with much more rapidity than it used to. If you go on page 23, over to the U.S. bond market, the white line is the yield curve. Again, the Fed said we're going to keep rates down an extra year. So now we're into 2013 and beyond. So rates are very, very low. Calm is around. People want you to take some risks, so all the money moves into the equities markets. It's a little bit like the coast is clear. So again, if you look on 24, 10-year Treasury is below 2%, and the Fed wants to keep them there. That means in the high yield market on 25, coast is clear. People buy high yield bonds, a little more risk. Spreads narrow. If you jump over to page 28, can't quite see it, but again, this is the Russell 3000 EFA index and emerging markets. Again, look all the way over to the far right. You'll see they're up. I'll get into what the up means to us, but they're still cheap. So it's off the bottom, safe to go out in the streets again, and people are really redoing their portfolio. And it's interesting because we're in the middle of switching to the old asset allocation, new asset allocation. So it's actually not a bad time for us to catch some of this. You can see it clearer on page 30. Someday we'll get this printed nicer, but if you can see the second to last dotted line series on the right, that shows you basically what happened in January. So again, these are December results. I'll walk you through them, but January, the markets were on fire. Everybody put their money out of very, very risk-free things into the stock market, which again was cheap and in my opinion remains cheap. So if you look at FIRE's value on page 32, coming into December, we're about 7.7 billion. I can tell you at the end of January, it's probably back over 8 billion. So we're in pretty good shape. You can see how that looks. So the next page, 33, on a longer-term basis. So again, I'd like to think the end of January results are going to get us pretty damn close to the peak again. Page 34, you can see the old asset allocation. Remember, we went into cash when we thought there was a lot of risk in the water. I think it peaked at 9.5. December at 6. By the end of this month, it'll be below 4. And we have a bunch of stuff that we're working on. The main things that are going to get us from 6 to 4 that have already happened. We funded 2 hedge fund investments that were approved after December 30. We bought some emerging market passive, which again is executing board-approved things. We're in the process of hiring and funding an emerging markets manager that got approved at a prior board meeting. We've also bought some high-yield bonds. So again, if you go to page 35, this is a new asset allocation that we're working our way into. So again, if you look at, say, emerging markets, which is brown, which is the third series of lines from the left, by end of this month, it'll be slightly over-allocated. Emerging markets will be back in the range, working our way up. Hedge funds is working its way up. We're going to talk about that later in executive session. High yield bonds is moving up. The thing that has been the slowest is the opportunities fixed income, which is we're just bogged down, to be perfectly blunt, negotiating some documents. It's unfortunate because we totally had the right call, but these are very complicated arrangements and they're just taking longer than they ought to. But the
Legal issue or an investment issue? What are we starting with?
It's a legal documentation issue. These are custom made. This one that we're working on is now 100 pages long. So 100 pages, we start from zero, it just takes forever. So we're frustrated that we can't get it down to 20 pages, but it's I would say, spun out of control. There's a lot to negotiate. These are complicated arrangements, but I think we'll be done with that, Martin, this week.
Yes.
We said that Thanksgiving, just to manage everyone's expectations, but I think this actually might be the week.
He was pretty bad.
Say it, Lou. This week?
I didn't say which Thanksgiving.
I did. Anyway, so we're working on it, and then again, there's a lot of funding to be had. There's a lot of opportunities over multiple years. We missed this last one.
And we are working very hard on it.
We're trying, but it's I must say, it's frustratingly slow, and it is all, they're one-on-one documents and they're one-on-one negotiations, but at the end of the day, it is legal negotiations.
Would the manager say they have more trouble with us than other funds?
No.
This is just generic to the asset.
Yeah, it's sort of like creating a private equity fund or a hedge fund from scratch, which, takes months. Because it is a separate account, and they don't have anything like it. And it was our first also, so that makes it even harder. Although we have outside counsel, it's not their first. One of them shares the same outside counsel. So we're going to say, all right, we just did it with you guys before. Don't touch this document. This is it. So I'd like to think over the next couple of months.
Well, the good news is once we have the documentation in place, the others should follow in shorter order than originally.
Right. But it's longer than it should be. Not that it should be. It's just longer. And particularly frustrating because we really had it nailed timing-wise. If you look on 37, the reason I don't want to spend much time on December's results is, if you look at the top two blocks, the equity markets were sort of plus or minus 1%. The bond markets were plus or minus sort of plus 1 or 2%. But what's interesting is the next page, 38, next meeting we'll have a great meeting because the equity markets were up 5 to 7% in the U.S. and double digits internationally, as well as the bond markets were up. So again, that's why I'm confident we're floating around $8 billion again when we finally see the January numbers. That said, on page 39, we did make some money in December, about 0.5%. Year to date, fiscal year to date, we're down a little less than 5. Again, I would tell you by the end of January, we're back in the positive column, and if we can keep this calm going that we've got, we'll spend the next 6 months or 5 after January working our way up to positive results for the fiscal year. As long as there's no big downdraft, and I'm mildly optimistic that the money, if things remain calm, I think equity markets will go up, bond markets, risk premiums will come down, and we should make some money. So that's my crystal ball for the next 5 months. The rest, again, is the manager by manager, ups and downs on a monthly basis. We'll be very curious to see how the managers do for the rest of the fiscal year, because this should be pretty straightforward execution of what they're doing coming off the base. Anyone have any questions for Martin or Seema or Barry or Yvonne on any particular manager asset class? Otherwise, we'll be done for the public session.
Any questions? So if there aren't any questions, we need a motion to move out of the public session, move into executive session. Second? You have a second?
Second.
Any objections? Hearing none, the motion carries. We're in executive session.